Hello everyone, welcome back to the channel. Today we have an interview with Brompton, who is a long-time reputable provider of ETFs here in Canada, and has been employing covered call strategies since 2005. So here I'd like to introduce and welcome Chris Cullen, who is head ETFs at Brompton. Thanks Chris for the opportunity to ask you some questions today and for joining us.
Thank you so much for having me on. It's always my pleasure to join the financial influencers and answer some questions about our product suite.
So today we're here to talk about your new ETF that launched last month with the ticker PAYG. I think these days one of the more telling parts when it comes to learning about funds and their potential roadmaps are how they pick their tickers and their naming conventions of their ETFs. So for this particular one, can you tell me how you decided on the ticker PAYG and what the HighPay part of the name means within Brompton's lineup of products?
Sure, that's a great question. PAYG, I mean, was meant to reflect, I guess, the approach that we're taking in this ETF. We've offered covered call ETFs for since 2018 when we launched our suite of ETFs, and before that, we had 18 years of offering closed-end funds that had similar types of strategies. And in the past, actually our current lineup even has a lot of kind of coverage of covered call strategies where covered calls are an important part of the investment process, but they're really a secondary part. The first part is fundamental investment selection and portfolio construction, and looking towards capital gains and dividends from the securities that our PM team selects to provide returns. And the secondary, when I say it's secondary, we've always, for well over 20 years, given our PMs the ability to write cover calls to express investment fees. Like if there's if they're holding a basket of financial stocks and they think that earnings season is coming up and there's a little bit of uncertainty about whether it's going to be a strong season or whether there's going to be some disappointments, they could decide rather than selling the stocks and booking, potentially booking gains that have to be distributed, and maybe these are long-term holds that they don't want to sell. They could instead write some cover calls and help to weather through what might be a little bit of a rocky earnings season. This is just an example that I'm making up, right? But in that respect, it's really a tool to express their investment views. PAYG, the Brompton Global HighPay ETF, is meant to have really a cover call forward approach. So that is one of the primary investment approaches for PAYG. And the idea is just that we're going to try to generate a very high level of cover call premiums. So PAYG writes at about 45% coverage of the portfolio, and the calls are typically 2 to 3% out of the money. When you write calls like that, if you're 2 to 3% out of the money, then you give the opportunity for some growth on the portfolio that has a cover call, or the portion of the portfolio that has a cover call written on it. But generally, you're mostly producing cover call premiums as your source of returns. So we do have a robust target for yield in PAYG, just due to the nature of investment fund regulation. We're not really supposed to give you the percentage of that target, but it's easily calculable, and we pay out distributions twice a month on this product. So the focus really is on high levels of distributions for this product, and hopefully soon it will be a series of products, but that remains to be seen.
Yeah, I was just about to ask that because I noticed that you had the HighPay designation on it. So is there maybe intentions of building this out in the future to include more HighPay products or categories?
Yeah, I mean, we were really conscious of creating a brand that could be used more broadly than just one offering. We did dip our toe in the water with PAYG, and it's received some tremendous support so far. We're north of $55 million now, and we launched a month ago. So I mean, it's been great in the retail channel. We've been getting lots of orders, and we can see them. We don't know who buys our ETFs, but we can see the types of trading that goes on, and so we've seen a lot of 100 to several thousand shares being purchased through Quest Trade and through TD, which is prolific in the discount brokerage sector. So lots of do-it-yourselfers and lots of followers of YouTube influencers have been getting involved in PAYG. We've had some tremendous support too from the full-service brokerage channel as well. Our sales team, which normally covers investment advisors and goes out and talks about our ideas and talks about our products and how they can fit into clients' books at the investment advisor channel. They've been getting a lot of enthusiasm and been generating some pretty good sized orders. So it's really playing well on both sides of the market, the direct investing and the full service brokerage sides.
Yeah, for sure. Like you said, this ETF has drawn a lot of interest among the covered call crowd of investors since its launch. And I think it's mostly due to the growing interest for more international exposure lately. This space being maybe not as occupied as some of the other areas the market so far. And then they're also looking for the cover call overlay and on top of that 25% leverage as well, right? So
Yeah.
Can you talk about how this ETF generally came to be in terms of like the stock selection and maybe how
Sure.
you guys decided to create a basket of single stocks versus maybe an international index instead?
Our PM team, as I had mentioned in an earlier comment, is a very active team. They spend time doing research and meeting with companies and doing the full top down, bottom up approach to stock analysis. They're very careful constructing portfolios, and they intend to use these skills on this portfolio. So buying individual stocks directly is the way to do that if you're going to be trading in and out. You'll notice that none of these are HighPay ETFs that have a single name in them or whatever. Some of those types of funds you can become a little bit tied to holding only your suite of single name high cover call ETFs. So that's not really what we want to do. We want to be active and use our team's skills to the fullest in managing this portfolio. And then as far as how the portfolio was selected, we were just looking for a good balanced distribution across geographies and across relevant themes that we viewed for this portfolio. And there's a little bit, in terms of the themes, there's a little bit of barbelling. At the top, the two themes at the top are very high growth themes: AI, infrastructure. It's been on everybody's mind, and it's been driving markets higher since 2022 when ChatGPT was released and the market caught fire, really caught people's imaginations, and it's starting to impact company bottom lines too. So some of the builders of this AI infrastructure, we thought it would be very important to include them. I mean, Microsoft, NVIDIA, that kind of thing. ASML, you may or may not be aware of, but they are enablers of the chip technology that allows NVIDIA and other big chip providers to build smaller and smaller chips and become more and more efficient in the space. TSMC is one of the clients of ASML, and they are a major semiconductor manufacturer. They make silicone wafers, etc., in Asia Pacific. The next theme would be global digital consumer platforms. That's one way of kind of summing up, what Amazon does with its online distribution of goods, and what Google does in terms of their investment in entertainment and search and that sort of thing. And we've got some pretty interesting additions on the Asia Pacific side too, with Alibaba and Temu, who you would know as a big product distributor, as well as Sony, who's a giant in a number of divisions, but entertainment is a very big thing at Sony as well. So participating in that whole distributing goods and services to consumers worldwide through digital means. So two very high growth themes, and then we're looking more for defensive and hard asset type of themes for a good portion of our portfolio too. So energy transition and real assets, that's a very big trend that's playing out globally. It's just simply the electrification of many previously fossil fuel types of energy sources. And also just about real assets. This is a great inflation hedge. If you have companies that own real stuff, like Shell has oil reserves in the ground, imagine the change in value in their oil reserves since oil started heading up north of US 100 per barrel. BHP and Agnico Eagle are similar on the mining side. They have very valuable deposits that their business is to extract them from the ground and to sell them. And the value of both of their holdings in terms of mineral deposits have gone up significantly lately. Defensive quality and value, we were just looking for some good, fortress balance sheet type companies with stable, non-cyclical businesses. I don't think we could have done any better than picking Johnson & Johnson and Lilly. They're both very, very prominent pharmaceutical companies. Citi and UBS, global banks with huge reach, and Walmart as well, who is kind of like the bricks and mortar equivalent of Amazon, really. So these businesses are not as affected by economic cycles, and they have very strong positions in their industries. So this was really how we went about it, just distributing by themes and by geography, and coming up with some good names that our PM team really believes in.
Nice. So I think I heard you mention barbell strategy a couple times, and I think that's kind of a core thematic approach when it comes to Brompton. So could you maybe explain a bit more about that for those maybe who are not as aware of what the barbell strategy is?
Yeah, sure. I mean, what we're doing is trying to pair, perhaps growth ideas that may entail, some good upside, but also there's risk as well, right? When you're looking into very growthy themes and growthy names, you get both sides of it, right? So our PMs pick names that they believe are going to, in the long term, produce very attractive returns. But there's always never a straight path to get there. So the idea just being that you take growthy themes that may have a little bit more risk, but also more reward potential, and you compare them with themes that are very solid and more defensive in nature, that have good returns potential, that have perhaps a lower volatility outlook, and put together just a well-balanced portfolio between those two kind of ends of the risk spectrum and ends of the reward spectrum. So yeah, that'd be kind of how our PMs would describe it. Would be like a barbell. There's a weight on each end, and it provides balance when you go to pick up the barbell, right? You don't want to have a barbell with one weight on one end, right? That's not going to help you very much. So that's the idea, anyways. I hope I've described that properly.
Yeah, nice. That makes sense. And then looking at the holdings, you have 20 names right now. Is that number set in stone, or maybe what might the criteria be for adding or removing holdings in the future?
I mean, when you start up a fund, we usually start by listing $1 million of units, and so we want to have good diversification, but it has also got to be investable and manageable. So 20 names was a number that we settled on, that we can buy all these positions and we can invest. A startup fund. The day one when we listed, it was fully invested. And another factor too is when you're writing covered calls on a significant portion of your portfolio, you need to have enough stocks so that you can actually trade a board lot of covered calls. You need at least 100 shares to be able to sell short covered calls so that you can have that coverage. So that kind of drove us to that 20 level, the balance between, again, and we're barbelling, right? Balance between good diversification and in the portfolio, and being able to execute on the investment strategy through writing covered calls on it. And in the future, yeah, I think you could expect to see more names. I mean, this could be a $1 billion fund and hold these 20 names, and it wouldn't affect liquidity or anything. They're all very large cap and liquid holdings. But there is the opportunity to branch out, put different ideas in there. And our PM team will be looking to continue to actively manage PAYG and looking for opportunities to expand or to transition sections of the portfolio into new themes that they think, maybe at some point some of them have better prospects than other themes. So yeah, it's 20 names, but it's definitely not. We're not finished with developing this portfolio, and it will be an active work over time.
would you look more at the liquidity or more so like maybe the fundamentals of the business in terms of like long-term growth when it comes to deciding adding a new name?
Hmm.
Um, or
Yeah,
and
no,
maybe also the barbell strategy too, right? Would you say you add one on one side and to balance out the other side, you add something on the other end of the spectrum as well?
yeah, I think it would be like you've got the right idea in terms of adding on both sides to kind of keep it balanced, but it's not as one to one as that. I think our PMs would kind of look at themes generally. They would look at individual company positions and how they develop over time, whether they're improving or deteriorating positions in terms of their profitability, their leadership in their industry, reputational type of considerations, new business lines that they could see growth in, right? So there's a whole lot of considerations that go into selecting these names, and I can't really pinpoint any particular one of them. On the growth side, a lot of it would be prospects for the industries that they're involved in, and for the products that they supply to the industries that they're involved in. NVIDIA is the premier chip manufacturer for AI training and inference, and so that leadership position would give a very strong positive when you're setting up kind of your pros and cons checklist for investing in any particular company. Very profitable, very very high levels of profit growth expected. So can't really put it down to one thing, or down to we're going to add one stock here and one stock there. But I think over time, there was a time when, like a long time ago, when automobiles, just regular combustion engine automobiles, was a very high growth, kind of sexy new technology. And over time, technologies mature and new technologies emerge. And so it's a very long cycle, but there would be consideration of that too. How is the market changing and evolving, and how can we best position PAYG to benefit from that?
Currently, it's kind of in between 5% to 7% allocation per holding. I'm wondering if the goal of the portfolio is to be roughly equally weighted, or how often do you plan to maybe rebalance the portfolio?
Again, kind of an initial positioning thing. And when we started, the day one, everything was 5%. Get 20 names in there, 5% each, and here we go. Going forward, there's no requirement that we go back to equal weight or we rebalance or anything like that, right? It's not a rules-based portfolio like that at all. So it may be that some names get added to, some names taken away from, and some profits taken, and some may be removed. Some new positions may be introduced. So it's going to be a dynamic experience going forward.
Okay. And then just a kind of fun question. So there's an old adage of letting your winners run. So I'm just curious how the active management take is on this when it comes time to maybe rebalancing.
Yeah, I mean, like letting your winners run. Kind of what that says to me is it's almost like you've made a rule for yourself that if it's up, I'm gonna keep holding it, right? Our PMs are trying to dig a little bit deeper than that. If it's up and it has good prospects for going up more, our PM team would make a call to continue to hold and let their thesis play out. And you got to have at some point when a stock rises to the level that you think is fair, or even beyond what you think is fair, you got to start thinking about selling it too. So there's lots of stocks that would still be rising, perhaps, when it was time to let it go. And so that all these considerations would play in for our PMs, but it would be more about their views on the continuation of the run that the stock's been on. It doesn't mean that if a stock goes up 25%, they're going to sell it, but they might if they decide that's full valuation and it's achieved, all of that what we thought it could, and now we've got a better idea that we think has more upside. That's quite a possible decision that they could make at that time.
And then to dive a little bit deeper, could you give me some insight? I think you already mentioned a little bit, but maybe how you approach rebalancing the coverage ratios on each individual underlying stock, and maybe also the moneyness of the individual strike price selections that you do.
Yeah, our PMs would be looking at, like, as far as rebalancing goes, they're writing quite short-term option contracts. It would be a month or slightly less, and they'd be, as those kind of come up to maturity, they would be looking to roll them again. They may be looking to allocate more or less to certain names in the portfolio just based on their views of near-term performance. Generally they'd be making a decision on option coverage and option moneyness on a monthly basis. And the moneyness that they're targeting initially is maybe 2 to 3% out of the money on average. That's not going to say that every position is exactly that, but that would be their general view. They look to these stocks as having good capital growth prospects. And when you write at the money on a stock for 100%, what you've done is you've sold away any prospect of future capital gains in return for receiving a premium on the options that you've written. We are trying to generate a good amount of option premiums, but also benefit from our PM team's insights and their ability to manage portfolios. So writing 2 to 3% out of the money, gives ample room for some capital upside on the portfolio. Now, they're not 100% covering these positions either. They're starting out at a 40 to 50% level. Let's call it 45%. So you have, more than half of the portfolio that's available for capital gains, and you've got even some good wiggle room for capital gains in the side of the portfolio that you've written cover calls on. So yeah, they are very as well as being income focused. There is good focus on trying to capture some growth in these stocks.
Okay, nice. And then just want to confirm that it's just you're running monthly options and not weekly ones, right?
No, we haven't gone to the weekly level. There's plenty of decay. Like really what you're looking for when you write a short-term option is that as you near the end of the contract, the value of the option drops faster than it did if you write a year out from the expiry date and you hold an option and you wait a month. There's a certain amount of value loss that you're going to see because there's less time to the end of the contract, right? But if you have written a year out and you wait that month, the decline due to the passage of time is much lower than if you write 1 month out from expiry and you wait a month until it expires, right? So that concept, I know it's a little bit advanced, but I'm not sure if all your viewers are familiar with option theory. But the idea is that if you're writing calls and you do it on a shorter term, it's quite possible to generate higher value because of that. The fact that that when you sell something and the value drops to zero, you make more money, right? When you're short selling and the stock goes down, you make more money. When you're really shorting options. When you have a covered call position, you own the stock, you sell the option. If the option get exercised, you have the stock. You're not at risk of that. But if the option drops to zero, you can write another one and get another premium, and you kind of maximize that as you shorten up the time. But our team really hasn't. There's like a balance of that, right? Like you want to maximize the time decay, but also there's costs to writing very frequently that you don't want to give up all the value of time decay because you wrote every minute or something like that, right? And you got to settle all those options and there's small costs, but it's like over time that can help to grind down your returns from writing calls. So again, a balance. Our PM team is targeting about a month to expiry, and the way that we're viewing it is that is more than sufficient to provide the level of option premiums needed to achieve this strategy.
Nice. Okay. And then in terms of timing, somehow you actually timed the exact bottom of the markets for the launch of PAYG.
Oh, so, yeah. No, it's because we're magic. We have a crystal ball. Daniel keeps it in his office across from me. No, that was very fortunate. We did come out end of March, and it was in a bit of a rough patch. And I know in the past we've launched ETFs like our Class A ETF, CLSA. We ended up launching that just a few days before before Liberation Day tariffs were announced, and we were like, "Oh, what do we do?" Right? But that was a fantastic experience, actually. Like that CLSA. I don't know if you know that one.
Yeah.
That's our split corp Class A share ETF, but that took off and it's done about 70% since we launched it last year. So when we saw, we launched that ETF and a war just being declared and the markets were like, oh my gosh, right? Like that gives us, that gets me excited, right? Like the markets are going to turn around and eventually, whether it was that month or whether we would have to wait a few months or whatever. But a lot of the times when there's a wobble like that in the markets, it can turn into some really good things in terms of returns. So yeah, it was. I think like a war is never something to celebrate, but that was quite fortuitous that quite fortunate that we were able to launch that right into the market that we did, and we've seen a good pop since then. So.
Yeah, the markets basically went up straight for the past 6 weeks, right?
Yeah. But we don't. Just to be clear, we don't actually have a crystal ball, but we just have some experience, and we've seen something like this happen before, and so yeah, we're very glad to launch that, and we're very glad with the way it's working out so far.
Yeah, maybe could you maybe talk about how you guys actively managed sort of the portfolio for PAYG during this time, knowing that it was rebounding and going to recover?
Yeah, no, we just did what we were planning to do, right? We had a good portfolio selected. A couple days before launch, our PMs did a gut check, and they liked what they were targeting. They liked buying it at the levels that they were getting these stocks at, and just kind of leave enough room for some upside through your cover call rating. And this is it. I mean, it's not that you don't put on a special portfolio management approach so much during rough periods, right? Because the way to manage portfolios is to be ready for rough periods before they happen. And then that's great if you can, if you can detect that the markets are going to take a tumble and what have you. But also, when they do take a tumble, be ready to buy, right? Be ready to know what moment that you should be going in and doing that. So. All this to say that the fund was really just up and getting launched after the war was in full swing, really, and markets had gone kind of shaky. So yeah, our PMs were very glad to get in there and make some purchases of really good companies that they were able to buy for a little less than they would have bought them for a few weeks previously, right?
And then on the income side of things. For PAYG, is there a targeted distribution amount, or is the variable distribution where it changes depending on the volatility and maybe the coverage you guys choose?
No, I think that 20 cents will be reevaluated. We've decided to look at it on a quarterly basis and then decide what is the new level that would meet our unspoken target distribution level and adjust at that time. And so, yeah, the obviously to fund that, activities might need to alter slightly. But if the distribution goes up, it will be because the NAV of the fund went up, and so it could likely support a slightly higher level of cover call rating to help out with that distribution level that ticked up, right? So that would be kind of how we would look at it. If we increase the distribution, it will be because the NAV has been strong and there's more to work with at that point.
And then currently the frequency is semi-monthly, but is there maybe potential in the future for more frequent distributions once it's available on the exchange? Or
I mean, I won't say no. I won't say no.
Yeah.
I would say that the decider of what can be done is CDS, the Canadian Depository for Securities. They're the ones that you need to kind of make sure that any distribution has to pass through their back office. And they've currently told us that twice a month is their breaking point. Not the breaking point, but for some of their staff that are like, we have so many distributions to pay now. So, in the future, yeah, if the technology changes, we will evaluate. I think twice a month is for the HighPay is is I think a pretty good level. Approximates a paycheck for people. So yeah, I think it's a really good idea, and I know friends of mine that aren't in the industry, friends of mine and my wife too that isn't in the industry, kind of describe this whole distribution to them, and that was their immediate comment from several of them. It's like getting a paycheck, right? You get it every 2 weeks. I love it, right? I've bills to pay, right? So, anyways, it's I think the twice a month thing is a good innovation for the industry, and we will consider further innovations in the future, but we don't have any that we're seeing on the horizon right now.
Yeah. And is that flexibility built into the prospectus currently?
Yeah. There's wording. We did spend a little bit of time with the wording around the distribution levels, and so it can be changed in the future. It's not locked in to twice a month.
Okay. And then just maybe one last question. Is there maybe a potential USD version in the future maybe that you've considered?
Oh yeah, we would definitely consider it. We need to get some kind of indication, I think, of interest. Typically, in the ETF space across the board, you would see CAD hedge funds like PAYG with a US dollar unit, and you'd get maybe 5 to 10% of the sales in the US dollar unit. I mean, the fact is, this is Canada. Even for U.S. investments, a hedged product is sometimes appreciated. So we'll see how that goes, and if we do get strong indications from investors, whether they're retail or whether they're in the full service channel, retail being direct investors, we would consider that in the future.
Nice. And then I think that's all the questions I have. I think we've gone over a lot of the important details, and you answered a lot of questions I've always wondered in terms of like the active management side of things. So thank you for that. Is there anything else you would like to add, or maybe ask the audience for feedback?
I just want to thank everybody that watches today. Great to have us on, and do appreciate that.
All right. Thanks, Chris, for your time and the opportunity to chat. Congrats on the successful launch so far, and hope to have you back on the channel again in the future.